If the bill passes, we will be back to that 100% bonus. What better way to incentivize small businesses to invest in hard assets, machinery, equipment, real estate, by allowing for higher tax deductions in the year that you actually spend parlay the capital.
What's up, guys? It's Ron from Rohde Law, and in today's podcast episode, we're sitting down with Mehak Begemann, who is a CPA and owner of her own tax advisory firm. Now, this episode is really important because we're going to talk about everything for real estate investors in the big, beautiful bill that's the BBB. It is racing its way through Congress, and Trump has made this a huge priority to sign. And in it, there are a lot of severe implications, not just for your investments, but for the real estate investing market in general. So, Mehak, welcome and thanks for joining us.
Hey, thanks for having me here. I've been talking about the tax law changes that are coming through with our own client list. So excited to talk to you today about what is coming down the pipe and see how this is relevant for some of your clients in the audience that you speak to.
Yeah, I think our audience, they are a mix of residential, like multifamily, commercial property investors, as well as traditional commercial industrial investors, retail, self-storage, but we're much more focused on the industrial, or much more focused on the commercial side. So, the things that I'm really keen on: 100% bonus depreciation, some of the other deductions. We have the SALT, that exemption is going up, but that's the audience. And I think people are really interested about what is going to happen to the market if this bill passes. What are your thoughts on the impacts to the commercial market?
That's a good question. And we have several clients who are in the multifamily space, some are in vacation rental, luxury vacation rental space. And we have some in the self-storage, RV boat storage space. And then, of course, you have others who are doing, hard money lending and parlaying into those type of deals, maybe not directly participating in it, but they're passive investors and the syndicators. Maybe they're on the GP side or the LP side. So you kind of see a gamut of investing happening across the board. I would say if the bill passes, there's several changes coming through. Let me bring two that are top of mind for me. You mentioned 100% bonus coming back. So what does that actually mean? So if you're catching up and you're like, maybe you haven't had enough time in the market just yet to remember what it was like 2017. So pre-2017, which is like way back when, you could only take bonus depreciation up to 50% on certain asset classes, right? And then TCJA, Tax Cuts and Jobs Act, was passed under Trump's first term in office, and he had proposed a 100% bonus, and we got really used to that, and frankly a little bit spoiled because we started assuming that if you buy an asset that's let's say 100K Tesla Cybertruck, business use only, that you can take entire 100K on that asset. So we kind of got a little bit used to that. All of those legislative changes are coming to a close. A lot of those were set to sunset in 2026, and it's right upon us at the end of next year. So what's been happening and I'm kind of laying the landscape so we can kind of catch up where we're at. 100% bonus, the last year was 2022. Ever since 22, we've been phasing it down to 80, 60, 40, 20 sunset. So that's why 2026, it goes to zero. Even before Trump was elected for the second term, I was convinced that there's no way Congress will actually let that go to 0%. Otherwise, what incentive is there for a landscaping, a mowing, a heavy equipment, real estate? Like these industries, they're very capital intensive, so you have to have incentives there. So that's where we're at now. Without the new tax law passing, the one big beautiful bill, bonus is down to 40% for this tax year. So for example, if you have, again, 100K Tesla Cybertruck, 100% business use, you can take 50K on it as opposed to 100K. So that 60K is not lost by any means. It's just you take it over the remaining 5 years, if you will. So if the bill passes, we will be back to that 100% bonus, which, if you think about the intent of the lawmakers, if you're trying to play both sides of the equation there, with the tariffs and some of the other adverse changes, I think he's really trying to stir up the economy with small business growth. And so, what better way to incentivize small businesses to invest in hard assets, machinery, equipment, real estate, by allowing for higher tax deductions in the year that you actually spend partly the capital, right? That was a really long winded answer, but hopefully that landscape kind of catches everybody up to where we are, what is the current law, and then what's proposed.
So I think that makes sense in terms of the depreciation for businesses, but for real estate investors, they're getting the same benefits of depreciation, right? Do you have to do like a cost segregation analysis in order to capture that for say like a self-storage property?
Yeah, that's a great question. So it depends on who you are, right? So if you're an investor and you're going and buying an existing self storage unit, let's say you pay a couple of mil for this new facility, you have maybe a lot that you're going to build out as cash flow eases up. Of that 2 mil, there's county assessor records to be able to determine how much the land value is, but the remaining purchase price, there's really no way to determine just on that closing disclosure how to parlay that asset into what would be considered 5-year asset, 15-year asset, 39-year asset. These are IRS terms for stuff that wears out in 5 years, 15 years long improvements, and then 39 years, maybe the hard asset that in a single family house, that would be the foundation. So the equivalent of that in commercial property. I find that cost seg is needed, and that's a short answer. I find that
Okay.
on storage units, cost seg is actually really favorable. So on a traditional small, single family, multifamily, you might be able to take 30% of the purchase price and pull that into the cost seg. A storage unit is up to 40, 50% of your purchase price. So substantially more. I always tell investors, we have a Rolodex of cost seg firms. We at least get 2 or 3 different studies, preliminary studies, because we want to make sure that we're optimized for the study and the cost benefit analysis, and just make sure you're covered on auto risk perspective. But yes, usually the first step is after you're in service. So whatever portion of that building is already in service, that cost seg is really going to help your CPA know how much of that can be bonused in a given tax year.
So help me understand, why is self storage subject to the bonus depreciation? You know, if it's placed in service and it's completed, why is that subject to bonus depreciation versus you're saying a house or a multifamily is not subject to as much? What's the difference? Is it just a metal box or why?
Exactly. I think it's the makeup of the asset. So generally, if you're thinking about a single family home, the lot size might be smaller, but the foundation itself is a bigger percentage of the total purchase price versus self storage. I find a lot of it is metal boxes. You can really make the argument again. Cossack is making these determinations, not us, but really more 15-year land improvements type of assets. So it's a larger asset to begin with for purchase price wise, and it just behaves differently, right? So you don't have really a lot of fixed foundation type things going on in an asset like this.
Okay, so do you think light industrial, flex industrial, which is also a metal building with smaller suite sizes? I mean, they do have a foundation, a slab foundation, but physically they're very similar construction. But do you think flex industrial could get those same benefits if you applied for 100% or
I think
max
so.
bonus?
I think there's an opportunity to reclass more of the purchase price and pull that into the 5 and 15-year asset. You have to think about, if everything deteriorates, like what's remaining. I know it's a very simplified way of thinking about this, but that's like the 39-year asset life. The stuff that's not going to wear and tear easily, that's it's meant to last. So I think Flex would do really well. Again, going back to like get 2 or 3 different preliminary studies, the market's very competitive. So most cost seg firms will give you a free preliminary analysis of your asset. Most of our clients, they don't, I mean, that you read the report, and you're like, I don't even know what this is saying, right? I don't even know what this means. So they'll bring that to us, and we're mapping that against like what is your income across the board, right? So most of our clients are doing multiple things, like they might be flipping houses over here, or they have a construction company here, or property management over here. So you got to see all of the flow of income and figure out how much does it actually knock off your adjusted gross income, and how much of the effective tax rate does it actually save you. Like that's like the end result that our clients are looking for, is like, what is my tax savings if I implement this strategy?
Yeah, that's a great point. You know, I think so many people go on the internet and they watch a TikTok video, they watch some YouTube video, and tax clauses or sections of the code, they're not meant to be taken in isolation. You can't just look at one section of the code and say, oh, I'm going to apply this and put this on my return. It has to holistically fit within your other taxable income and your filing status and all that stuff. And if you phase out for certain things. So, yeah, there's a certain, capital gains, no capital gains, it's 0%, right? But your AGI has to be below 100K, things like that. There's a TikTok video that says, here's one simple trick. So you pay zero capital, long-term capital gains. Oh, well, the trick is just don't have any taxable income.
Right. Yeah. So can I speak to that? Because I'll like parlay a couple of client examples. So for example, one of the questions I always ask our clients is what is your plan with this asset? Are you here to buy and hold? Did you 1031 into it? Because that would change your basis. Like there's so many things. So like let's just take those two examples. If you 1031, if you sold a storage unit, let's say, and you moved into a bigger storage unit, you pay, let's say you move from like a 3 mil asset to a 10 mil asset, your basis is not 10 mil. Whatever the deferred gain is, it knocks down your basis, right? It's like, so just because it's 10 mil, you can work your math off 10 mil because your base is actually less than that because you've deferred capital gains. So that's like
Yeah.
one
So
instance.
I think that's a good comparison for my stuff. I'm a big direct industrial investor, and I have partners. We don't do a syndication, but I have partners. And a lot of people ask me why I don't 1031, and it's exactly that. I don't do cost seg because I'm not going to 1031, and I'm going to sell it before 5 years, and it's just going to have depreciation recapture. The net effect for me is not that much of savings. Yes, it's taxes deferred for a couple of years, but so what? To me, it's not worth the cost seg study cost and time to implement it just to push taxes back a little bit. Um, but yeah, even with like $2 and $3 million of gain, my basis would be so low if I 1031. You would never get out of 1031 trap.
Yeah, it locks you in, right? It locks you in because now on the back end, so that's the intent of the asset is huge. We have some owners who have earmarked assets that are going to be in, presumably maybe even you, like this is here to stay. It's a long-term play, not planning on selling. The issues you run into is when there's fire sales because cash flow is dwindling in other areas of the business or your hand is forced, but you're up against a tax bill, so you got to cost X something. Now that's just poor planning, right? It's like you're looking back, you're not looking forward, you're kind of reactive in every decision making. And so you're costing assets that you're going to sell next year, but you need to reduce the current taxable income because you don't have the cash for that tax bill, for
Yeah.
example.
And I think subconsciously that's another reason is I like to operate with as few constraints as possible on my investment decisions. And when you 1031, it adds another layer of consideration, which is okay, if I need to fire sale this, well, my tax bill next year is going to be massive. That's going to cause a chilling effect on should I liquidate or should I sell this asset even for a gain if it's not part of your 1031 timing and structure. I think it's funny. I talked to my wife about this too. I think the only stuff that I would want to hold forever is something that I only own myself, with my family, or maybe one partner. But if I have deals with three partners or four partners, we have way too different life goals that we don't want to lock ourselves into making decisions that speak to a perpetual hold or a 20-year hold period. I don't know how long I'm going to live for, but um, that's really important. That I think people get so caught up in just tax savings today, they don't think about tax or future decision making in the future because they're just so focused on the here and now, and that's like 1 to 2 year planning as opposed to 5 year,
Yeah.
10 year.
So there's so many ways I can take this discussion. So I want to point out three main things. So for our clients who are successful, meaning, probably our biggest client right now is doing about 13 million a year in their fix and flip business. They hold about 100 doors, two partners, again, unrelated. So, the complexity of an unrelated partnership at an emotional level, at an investor level, is different than like a husband wife partnership. Then they own everything because you have much more similar goals. I mean, you have issues there too, but for unrelated partners, they have very different goals. So the point being that in their case, having a solid cash flow plan for their active operating business is so key. so that they don't have these fire sales. So they're able to actually, even if they want to liquidate, it's strategic liquidation of assets. And it's not just, hey, we've got a 600 tax bill this year. What are we going to sell to cover our cash flow on that? So for a business, if you're operating between the 3 to 13 million mark, and you don't, if and you're just like your bank account is just like up and down constantly, like this, like crypto, if you will, you need some help, because the way you've grown to like 3 million is not the way grow past three, 6, 10, 12 million. They're just getting your systems. That's like a commonality I see with our CFO clients, is that the systems really need to be dialed in, because most of the time they scale up and then have to scale back down so that they can build back up to
Yeah,
that level.
I think it's a great point, and it's something that people ask me. With 7 or 8 industrial properties, they're like, "Do you budget for capex? How much are you setting aside for repairs and maintenance?" And my answer is none. I don't even escrow really for property taxes if the lender doesn't require an escrow, because I can just pause distributions or build up cash flow to pay for anything that I have needed to pay for in the past with 2 months of cash flow. There's just nothing. 150,000. I can just create the money. Same for a tax bill, but if I was hit with a 600 tax bill, I can't quite create that in 2 months. So I probably should be better. And to your point, systems that got you from 0 to 2 or 3 million are not going to be what's going to grow you from 3 to 6 or 3 to 10.
Yeah, I think it's no different. And if you're doing high volume, and this is like every business, it parlays in different ways. Like the way you got your first 100 customers or the first 100 flips, like they're your starter. Like you're gonna step up into bigger, better deals. And so that's why, yeah, that's just what you have to think about from a systems perspective too. And a lot of our clients on the CFO side have really good systems on. They are tracking marketing. They have different channels. They know where their leads come from. So like they're dialed on their front end of that cash flow cycle, where just lead gen and going to all the masterminds and understanding all the pieces of it. But then there's just like a massive leak on the back end. So wanted to insert that to say, like, tax is just one piece of the house. You want to get your house in order overall, so that this one piece doesn't take you down because you failed to plan for it.
For my defense, I'm doing my quarterly estimated payments now, so hopefully I won't get a 6K tax bill, but I am putting like 1K a quarter to the IRS. Just to, I think it's even below what my estimate is, but I just try to give them something so that bill at the end of the year is like 200K instead of 600. I can pay that.
Yeah. So you made a comment about 10 things and the trap that it can be. And I totally agree with that. However, something that's often overlooked by some of our investors is the OZ, the opportunity to do opportunity zones, which is massive, right? So again, now like you're talking to somebody who's heavy in tax planning, not tax prep. So OZ planning starts before you even have the cap gains, because there's so many. I mean, 1031s like that too. There's so many. You have to literally stay within that period of time and dot all the I's, cross all the T's. OZ is like the next level of that. But most of our clients who will even touch OZ have massive gains coming through. And sometimes it's real estate, sometimes it's not. Sometimes it's a family business that was a C Corp that liquidated, and they have this massive, massive capital gain from the sale of this family business, or they have other gains coming through that are just they're not real estate related, but they want to parlay that into real estate. Sometimes they are real estate related, so it just kind of depends on what.
Maybe give us a 30,000 foot of OZ, because I know it's been around for a while. It's been around for 10 years.
Yeah,
Haven't seen some of the explosion that we thought, but it is a strong program. And I know, like in Dallas, for example, there's a multifamily developer, Barrett. He does a ton of OZ. He's a big champion for that. But tell us what OZ is and how it could be a good fit. Yeah.
yeah, let me give you just a very high level, because there's so many rules attached to it, and you really have to dig deep through this before you even make a move. But a really high level overview. So with a 1031, you're deferring cap gains. So let's say you bought an asset for 500K, it grew to 800, you sell it. Let's say on market, you have a 300K delta there. I know, very rough math, because depreciation also plays a role. But that 300K, you're just kicking the can down the road. It's eventually going to catch up, with the exception of step up in basis. If you hold that asset until you pass away, and then your heirs inherit that asset, then it washes, right? Because they get the step up in basis. There's no cap gains paid unless they hold on to it for a while. But in your lifetime, you're just kicking the can down the road. You're not really able to, I mean, like you say, you're trapped unless you're like, okay, I'll just take the hit this year and do something else to create some sort of tax reduction on another side of the equation. But with OZ, it's different. It's washing the cap gains. Now, with the tax law changes, they're going to add some more parcels of land to the OZ tracts. So that's a big one. The existing, this it's very vague. The first year this was passed was 2017. So it's relatively, I mean, it's old, but it's relatively new in the tax code. So it feels very gray. I'm part of a mastermind that's like OZ, it's an OZ attorney. I just want to make sure on the compliance, I'm on the up and up. I'm being on the front side of this to like really see what changes are going to come through. But again, at a high level, you have cap gains. You can fund the purchase of an asset inside of an OZ. It can be a small single family, it can be storage, it can be an RV, it can be anything. But the initial capital investment into that new asset has to be with the cap gains, so which works really nicely, right? So if you have, let's say, a mill of cap gains, you don't want to pay tax on it. You can parlay into that into an OZ property. Now, there's a census tract, there's data out there, and there's various search tools. Probably send you one to link to the show notes here, where you can search like, okay, this is where I'm trying to invest. Like, this is my box of where I like investing. What's in the opportunity zone in this area? So you have to set up an entity structure that plays itself into the OZ. Usually there's an OZ fund, like there's a hold co and like an entity underneath it, the qualified opportunity zone business entity. And so essentially, like the key takeaways there is that the entirety of the initial capital has to come from the capital gain. So you're not, and then you can use debt as well, but there's an asset test you have to meet. It has to be original use. It has to be improved.
Do they still have the substantial improvement requirement? Okay,
Yeah.
so you can't just buy an existing property and that's it, closing and then do nothing. You have to buy it and then still do the value add.
Yeah.
And how much do you have to put in to qualify for the value add?
It's substantial. I want to say I can't remember off the top of my head, it's over 70%. It's substantial, right? So
70% of the purchase price, right?
yes. So
Yeah,
you almost nearly have to double it in value. So it works really well with raw land. For example, if you're a builder
right.
and
Raw
then
land or some type of non-habitable structure that you've got to demo and add, utilities and
like
add a
one of
new
our clients, they took like an old Lowe's that had gone out of business and turned it into apartment buildings, for example.
wow,
Um,
okay.
so like substantial. But with the tax law changes, I think that's coming down to 50% improvement, which would be
Okay.
substantial. Like,
Yeah.
yeah, not
Yeah.
tax law yet, but it just, when you have a bigger problem, you need better solutions, which OZ tends to be a better solution. It just doesn't come, it's not very easy
Yeah.
to make sure you're on the up and up with
And
compliance and
is
accounting.
it just hard costs like, raw material or construction, but what type of
It's
soft
total,
costs are,
all of it, right? So the labor cost would be another big one, just because if you
but
think
soft
about,
costs, I mean like permitting or architect or lawyer fees or CPA
I
fees,
think
those
they,
all can.
I think they all count. Why? Because with any asset, like if you think just gap accounting and tax accounting, when the asset is not in service, all costs get capitalized to the asset. So
Okay.
essentially,
Okay.
they're all included in the basis of that improvement until it's in service.
Gotcha. Until it's put in service. Gotcha. Gotcha. Okay. So yeah, I mean, honestly, depending on the permitting process and some of the design plans, you could have just kind of a regular value add plan. And between all of your hold costs, if all of that gets wrapped up into the basis, you could probably make a budget for 50% now pretty easily. And it's not like you have to do new construction ground up to
No,
hit
you
50%.
rehab it. I mean, it can be and then original use, like that's a big piece of it, right? But
So super interesting. I guess what more are you seeing? Is this a low period in terms of tax prep busyness? Because one of the biggest questions that I get is my clients don't love their tax advisor,
really,
CPA, bookkeeper, whoever is filing the return. I mean, I think it's really rare that somebody loves their CPA. So what would you recommend for an investor about how to find a CPA that you love?
I think if you're working with a strategic advisor, because I'm not hearing that our client retention year over year is extremely high. We actually have had to let go of some of our smaller clients just because of capacity constraints. So we're really trying to work with investors like yourself who have multiple assets who continue to grow. But clients or prospects of yours are like, we don't really like our account. They're probably receiving bad news at the end of the year from their accountant. Most of our, we're doing estimated calculations, but that's just one piece of it. Most of our tax planning is really scenario analysis. And I think I see that because I sit on the CFO side. I spend a lot of time in forecasting and forward looking stuff on the CFO side of our client, of our business. And so for our tax clients who are big enough where like it's a meaningful difference to show them, okay, as of year to date, this is what your earnings look like. This is what your tax bill is. You parlay strategy one, this is what that looks like. Strategy one and two, like you're kind of multiplying that to show them various analysis on like, this is how this shakes out. And but if you do one, two, and three, then it cuts your tax bill by 50K. Now, whether or not the investor has or the owner has an appetite to implement everything that you're saying, asking them to do, or has a cash flow, or has access to capital, or has a deal on the table. Like there's so many variables, but most of our clients value that the clarity in their options because now you can tie those to action steps to say, okay, by year end, you need to, even just a step contribution, or still a 401k contribution. You need to make sure you put 60K. And this is a wages that you need to run through there. This is an S Corp strategy, very common. But now you have targets, not just arbitrarily this tax plan that doesn't get followed up on and doesn't get, completed by you.
Yeah, interesting. So, do you work with any people on the fractional CEOs or CFO side that are still W-2?
Yeah, this
Like,
is so probably not. So our
probably not.
I
Okay.
think the clients who see most value out of the fractional CFO service are businesses that are right in that 3 to 12 million top line, so revenues. They're producing income, but they're not keeping any cash. So they're like, so, and a typical example is like we set out the real estate business to really build our buy and hold portfolio, but they keep parlaying into like whatever the business is, fix and flip, wholesaling, property management, there, or even your law firm for that example, like just any business where you're like, our end goal is at some point we want to build this legacy thing, but we're sucked into this operating thing and we can't get out of it. Right. So it's like, where is my cash going? Like that's the most common symptom, I would say. Or they're growing steadily, but they're not hitting their milestones quickly enough. So they want to be at 5 million, they want to be at 6 million. They're constrained on capital, they're constrained on people, but they don't know who they can hire or when they can hire. I have a client who wants to bring on a COO really badly because they really want to grow that next level, but they don't know if they can afford to pay for another high level team member like a COO without taking a massive cut in their own pay, for example. So that's really where we see the most value received by owners in that.
Yeah, it's super interesting. So, if I hear it right, if you're a business owner and you're unhappy with your CPA, maybe you need a fractional CFO to solve the problem during the year and not just compress it on the tax prep at the time of tax prep. Because obviously, the strategy is too late at that point. And I think people maybe are expecting too much from their tax return preparation, even if they have a bookkeeper. I have a full-time bookkeeper. He can prepare all the data, but then when we feed it to them, it's too late.
Yeah.
They can't look at it as a holistic approach. So if you're unhappy with your CPA and you're a business owner, then it's time for a fractional CFO.
I also think that most bookkeepers are looking back. So they're in the past transaction. So they're just booking stuff as it's coming to the bank account. And I mean, we serve clients just on the tax side. Like, I'm not thinking as a fractional CFO if you're not one of our clients because it's 12/31, it's year end. We're looking just from a taxable income perspective. So you almost get these like super focused, hyper focused individuals who are just doing their piece. That's why I think of them like as rooms in a house as opposed to like the entire house. Whereas a fractional CFO really is like overseeing, they're the head of your accounting department, even when you're a small business. And they're a support to your bookkeeper because your bookkeeper can come to them with questions and they're getting eyes on your P&L and your financial statements, balance sheet every month. they're seeing trends like, hey, what happened here? It looks like, payroll doubled in 3 months. Like, what's going on? Or marketing doubled and your sales are staying stagnant. These are like indicators that you need. Like, I was just talking to a client this week and their target gross profit is 60%. Well, they're operating at like, they have no margin left. So their target is 60, they're operating at 30. Well, that's the entirety of their cost. So they're net negative like in the month of June or in the month of May. So it's like we need to reset targets for June because but your CPA is not thinking about that. They're thinking about taxes. Like they're not thinking about your margins and your KPIs and profitability and what are revenue drivers, who's underperforming from at least a balance sheet perspective and a P&L perspective. So I think the biggest piece that I see, I worked at KPMG for many, many years. And in the small business space, like the biggest disconnect I see is that we start out as operators and we are owners, like business owners, and then we start hiring. But it's like graduating ourselves out of the operator mindset is like the biggest piece because we're, again, going back to like how do you grow from nothing to 3 mil? Like you just do more, you just keep bring on more and you're just doing more of it. And
Right.
then you start to build out a team and you have overhead now. And so I think that's the piece because I see a lot of businesses shrinking their margins at once they hit that 3 mil mark.
Yeah, that's a great point. I feel like people acknowledge what you're saying generically, but they don't know when that tipping point is. It's kind of okay, we're growing, we're growing, we're growing. What point do they bring somebody on? There's no magic threshold.
There's not, and that's why I think the symptoms. You go to the doctor. Well, hopefully you don't. Hopefully you're not like me and you wait till you're just feeling really poorly to go to the doctor. But I'm guilty of that. Just being a busy business owner and a mom to my children. It's like you don't want to wait till you're like absolutely feeling just can't even get out of bed and there's like an ongoing issue or something. You want to get in front of it, and I think that's a common thread in our business owners, right? Like the ones who are successful, they're proactive in just all things. But they also have the privilege of sitting in the CEO seat. They've pulled themselves out of the operator role to say, okay, I need to have 1 day a week. My cadence is Mondays. I have an hour of time where I sit in the CEO seat for my own business and say, what is like way out there that needs to be addressed, but I don't want systems to break before I go address that thing. And for us, it's making sure as our volume has grown that our service is stayed very high level, high touch, right? So for some of my owners, it's like they have deals in the pipeline that they're not going to get funded unless they can go make more connections and shore up private money. Like that's one of the things that they have to focus on. Or marketing, like they're spending 60K in ad spend every month, haven't had a chance to look what is underperforming. Like that's a big issue. So it's like you
Yeah.
have to pull yourself out of the day to day and create space to be the CEO. When can you not make that happen? It's when you're worried about your bills and payroll. Like if you're just like so worried about the day to day, you don't even have capacity to be the CEO because you're just putting out fires all day, right? So if you're putting out fires all day and you're high volume, that's a symptom. That's a problem. Something telling you that something's breaking in the business that you need help.
No, absolutely. I think it's so important that every level of investor, because real estate investing is like a business. It might be a very simple business, one that doesn't require a ton of high touch, but it is a business. You have revenue from the tenant, you have an acquisition cost, you have your basis, you have ongoing expenses. You've got to balance your debt, your debt service costs, taxes, everything. It is a mini business with not as many levers to pull, but I think more investors would benefit from understanding that their investment properties are a business. They should be viewed cohesively and taking time to evaluate and say, okay, what's my return on equity, what's my return on effort for managing these real estate properties? Because too many people just kind of go in the motion, right, of just buying more and doing the same thing without taking that CEO or CFO approach, right?
I would also say, even just with your own goals, it's like, where do you want to be in, 3 to 5 years, 10 years? Like, what does investing look like? Because, and you have partners, and it's very hard to raise capital, especially if you're not syndicating deals. But if you're like, hey, I'd love to go do this deal over here, but I need to go pitch myself to like these five individuals who I think have some capital who would be willing to put money in with me. Well, you need track record. You need to be able to show these people that, hey, you can take care of their money and do it well, and then present yourself in a way that shows credibility. So it's like, how do you do that without having any sort of like, you need some sort of, anytime you do go to a public offering for a syndicator, they're gonna show you past returns. And so you need something that tells a story of what you've done in the past. And that's what the financial statements are. They're showing that's a proven track record of the deals you have done and what the returns are. Like it just makes you a better investor when you're trying to do bigger, better deals and need to go ask for money and you're confident in like knowing that you can get the deal done. Here's my track record, like
But
raising
raising the
capitals.
money is tough. I mean, I think right now in today's climate, GPs are having a very hard time coming up with raises. I see a lot of distressed multifamily that's being acquired for less than the debt basis, attractive markets, relatively newer vintage. And these operators are struggling to raise the money. And these are small rate, like 2 million or less. They're struggling to fill it. I'm getting so many emails, last chance, still some space. Industrial, same story, from that retail investor, they are definitely bitten from the last cycle. So you've got to really invest your time really wisely and probably allocate more time to fundraising and oversubscribing than before, right? It's not just one email blast and you fill your raise. You've got to really spend some time, which means taking time away from other activities.
Yeah, totally. Yeah, I have a client right now who's raising capital in an OZ deal in senior living, and he's going to put a lot of his own capital up, and again, and that gets even more niche because it's like now you're really, from his perspective, targeting an investor who has cap gains, who would like to wash capital gains. But again, if
Yeah,
you're on the other side of this equation and you have cap gains, and you're worried about that tax bill, and don't want you're either too skittish or don't want to take the time to learn everything about OZ. You just want somewhere to go to park your money and have the tax benefit. Then it's like a marketplace, like it's like a closed marketplace. You don't even know it exists, but like people are raising capital for OZ deals all the time. It's just a matter of like being in the right room at the right time. I would say even for my high W2 earners, because we do have several of those who would never go flip a house themselves. They don't want to, but they want to invest in and they want to be an LP in a deal. So I think it's some of that too, which is, from people who are raising capital, it's not easy, and like how you present the message is everything. And how do you make it to where it makes sense to the person who's trying to understand what you're offering? So I would say that capital is tight right now. It's true for hard money too. Like if I have flippers in the space who are flipping, about 50, 60 houses a year, and cap is expensive right now. So I would say that if you're a business in that space, you really need to get your construction, like need to have KPIs that are well measured, because your margins are just going to slip because time on market has gone up overall. I have 8 clients right now, and they're all seeing longer time on market for flips to sell. So now between high carrying cost and labor costs and material costs going up, margins are really starting to slip, and you really need to get ahead.
absolutely. No, I think that's great advice. I hope people can take away something about managing their own investments with a sophisticated financial approach, but doesn't cost them, a full-time CFO, which maybe doesn't happen for even the $15 million businesses, right? A full-time CFO is expensive. So what's the answer? Part-time CFO, right?
Right. Yeah. And we're capacity constrained too, right? So there's only so many businesses that we will work with in a given quarter. And most of the time we have some that will keep us on year round on a monthly, month to month. But then there's
Yeah,
others who are like, hey, we're at 3 mil. We would love to hire you. We cannot hire you. The prices on, they're just not what the business can afford, but we need you. So let's do a time engagement, right? So like then we'll do like a 10-week engagement. It's like, let me come in, let my team and myself come in, fix a bunch of stuff, create some financial systems, and then give you some room to grow. Um, to where your bookkeeper can like, they have guidance and they have SOPs, and like this is what's expected. Like here's a cash flow forecast. Let me train somebody on your team who can, maybe even a VA. Like it's putting numbers on a sheet, but you need to know what you're looking at, right?
absolutely.
So for
Yeah.
some of our clients, like that time engagement is like just exactly what they need. until they're at a bigger size to where they can afford the services month over month. And for others, it's like it's synonymous with like having a bookkeeper. Like you just need a CFO who can help me understand what's going on while I'm going and doing deals. Like I need somebody who can just manage all of this back end accounting stuff.
Yeah, absolutely. Well, that was awesome. I really appreciate your insights. I mean, I think the big beautiful bill is going to shake things up. Hopefully, it passes, and we'll see real estate come back. Rates are dropping a little bit too, right? We saw the Euro central bank drop, so maybe the U.S. will come, and these things are just going to hit like a catalyst. So I think when real estate comes back, and it's going to come roaring back with all these benefits.
Yeah, I'm really excited. I think, if you were pre 2020, like you see a really upward swing in the market, there's there's opportunities that you sometimes miss because you weren't ready for them at a given point in time. I really think that even though real estate prices have gone up overall, there's going to be a lot of wealth creation. I mean, we didn't even touch. We'll have to have another session like talk about once the bill passes, hopefully the estate tax piece of it and like the ceiling on that going up. So I just think like overall tax law changes when Trump has been in office, love him, hate him, it's kind of a character, but they have been overall positive for business owners. So I
Yeah.
really think that there's going to be over the next 4 years, there's going to be a lot of moves that business owners can make to really lock in some generational wealth for themselves and their families.
Absolutely. Well, smash that like button, subscribe to hear our thoughts once a form of the bill passes, right? Because even the House versus the Senate version is going to have some changes. So bookmark this, come back to the channel when the bill does pass, and we'll take a look at what that means for you and how to optimize your investments. So thanks, Mihak, so much for joining. It's awesome to learn a little bit more about what you do and how it can help other real estate investors.
Awesome. Thanks for having me.